Good morning, viewers. It's Wednesday morning, April 16, 2025, and I'm your host, Sunil Thakker of Sunny Talks Money. Welcome to ST Money 7 a.m. early morning news, where we provide you the latest, concise, and precise stock market wrap with accurate figures and numbers. Investors enjoyed another day of much needed rest and recuperation on Tuesday after the last few bruising weeks with no further strains in global trade tensions or left field policy announcements from the White House, pushing bond yields and volatility lower, although Wall Street closed slightly down. Stocks whipsawed as President Donald Trump's fast evolving tariff war with top trade partners showed little signs of abating, leaving investors unwilling to take on too much risk after a 2 day rally. There were no major flare up in the global trade war, although, much like Monday, lingering tariff worries tempered any sense of relief on Wall Street, and US stocks lagged their global peers. Major indexes had risen on Monday, helped by Trump's comments that he could pause some auto levies, and by weekend news, some tech products would be exempt from reciprocal tariffs. The government also said it had opened new probes that could lead to pharma and semiconductor tariffs. Trump released a new statement on China on Tuesday saying that the country needs to come to the US to make a trade deal to lower the tariffs the US had levied because the country needs US consumers and their spending. The Dow Jones Industrial Average fell 156 points, or 0.38% to 40,369. The S&P 500 lost a mere 9 points, or 0.17% to 5,397. And the Nasdaq Composite lost a meager 8 points, or 0.05% to 16,823. The VIX index declined for a third day, but still closed about 30, as it had done every day since April 2, Trump's Liberation Day. The index is roughly 50% higher than its normal levels. Strategists also are paying close attention to the technical charts after the S&P 500 50-day moving average slipped below the 200-day moving average on Monday, producing a death cross pattern that suggests a short-term correction could turn into a long-term downtrend. The S&P 500 remains 12.2% from its February 19 record high close and down about 8% from the year to date. S&P 500 companies have just begun to report results for the quarter ended March 31, but changes in the US trade policies are muddying the outlook, and executives could be reluctant to give earnings guidance. 7 out of the 10 sectors of the S&P 500, however, closed in the red, led by a 0.7% fall in consumer cyclicals. Shares of consumer and healthcare companies eased, while upbeat results from banks provided some support. Johnson & Johnson shares ended down 0.5% after the company missed estimates for sales of medical devices, despite beating Wall Street estimates for first quarter revenue and profit. Johnson & Johnson's chief executive said that the tariffs on pharmaceuticals can create supply chain disruptions, and that favorable tax policies would be a more effective tool to boost US manufacturing capacity of both drug and medical devices. Also in the healthcare space, shares of Merck and Company ended 1% lower. Barclays on Tuesday downgraded the US auto and mobility sector, saying Trump's tariffs could pressure automakers' earnings. Shares of Ford closed down 2.7%, while shares of General Motors fell 1.3%, and the S&P Consumer Discretionary Index slipped 0.8%. Whereas earlier, global car makers like Toyota and Hyundai tracked a Monday US auto rally. Luxury stocks sank after industry heavyweight Louis Vuitton Moet Hennessy reported a drop in sales as it contends with mounting trade tensions and faltering Chinese demand. Among the biggest weights on the Dow was Boeing. Boeing stock fell 2.4% after Beijing told Chinese airlines not to place new orders for the US company's planes. That would pull one of America's flagship manufacturers more deeply into the trade war between the two largest economies. In late hours, United Airlines Holdings Incorporated stood by its full-year profit outlook but warned a recessionary scenario would erode demand and dramatically lower earnings. The best performing stock, however, were in tech. Palantir Technologies up 6.2%, Netflix up 4.8%, and Hewlett Packard up 5.1%. Wall Street trading desks are minting money from the tariff chaos. Wall Street is raking in even more money from trading than it did during the market's COVID 19 era swings. Results from Wall Street's financial heavyweights underscored an equity trading boom and still healthy consumers and businesses. Goldman Sachs, JP Morgan Chase, and Morgan Stanley all said a surge in trading revenue helped lift their profits last quarter and beat expectations. For the first quarter, Bank of America and Citigroup joined other big banks in reporting higher profits that topped analysts' expectations. Both banks experienced a surge in trading revenue, with investors positioning for Trump's tariffs. Americans say they are getting worried about the economy and inflation, but banks say they aren't acting like it any yet. Bank of America and Citigroup said Tuesday consumer spending ticked higher in the first quarter when concerns about tariffs and the economy began to bubble up. JP Morgan Chase said last week that credit and debt card spending rose. On Tuesday, Citigroup reported a jump in profit and revenue due in part to market volatility that generated higher fees for its trading business. Its shares had jumped nearly 4% in early trading. Bank of America also posted better than expected profit with revenue boosted by its market segment and wealth management arm. Its shares rose nearly 5%. Though it is too early to draw too many conclusions from the recent spending, as uncertainty and slowing growth could be bad news for other parts of the bank businesses. But for now, banks haven't signaled any serious distress among consumers or moved to rapidly build up defenses for potential loan losses. My take: peak fear. Activity, sentiment, and asset price direction across markets on Tuesday could probably best be summed up by the maxim that no news is good news. On a day where headlines were bereft of catalyst, it was kind of a rudderless and wayward market. Consumers are continuing to spend, which signals at this point that the US economy still remains in good shape. Earnings have been pretty good as far as the results from Q1 are concerned. But remember, those basically occurred in a world that does not exist really anymore. Today, this is a market that just beset by tariff and trade uncertainties, and those are really the only catalysts that matter at this point. Business leaders and companies will have to just kind of punt and resign the guidance. Investment managers will have to advise investors to avoid making hard and fast assumptions about how tariff developments will ultimately play out in the economy and on corporate profits. And though fund managers are max bearish on macro, not quite max bearish on the market, the best thing that can happen is obviously clarity and reduced uncertainty as quickly as possible. And when that happens, certainly an active environment will be unraveled. Until then, it is peak fear. And that's the wrap for today, my dear viewers. And if you got value from this, please do subscribe, like, and share this video as much as possible. You can contact me at st@st-money.com for any further information. I'll see you again tomorrow morning. Tomorrow will be the last working day for trading, as Friday will be closed. The markets will be closed for Good Friday. In the meantime, happy investing, stay inspired, and remember, it's all about money.